back, guys, to the Smart Network. I'm sitting here today with Rainer Davies, and on our last video we discussed property investment quite a bit. Today we're going to go more into the paper investment side of the business, and yeah, that's also why Rainer's speciality actually. So yeah, Rainer, how's things going?
Yeah, lekker. Your side?
Can't complain.
Good. Welcome, guys. Yeah, so today we've got some exciting things happening on this side, but stay tuned until the end. We'll elaborate more on that. Yeah, let's get it. Okay.
So let's jump into it. So Rainer, why are financial investments not a guarantee to make money?
Well, but that's a good question, but I can also ask the question, what other investments is guaranteed to make your money? So in the financial environment and in the investment world, which obviously I deal with on a daily basis, investments rise and fall, correct? Markets incline and decline from time to time. And I always say, and I've mentioned this before, you're always going to have to look at the factors involved. And there's internal factors and there's external factors. And the internal factors is things that you can control, and the external factors is things that you can't control. Internal factors being what product are you investing in, and what investment vehicle are physically putting in your funds. On the external side of things, there's obviously the macro environment and the macro factors that come into play. We don't know what will interest rates be or what will inflation be in the next year from now. Yeah, we can project and we can assume and all of these things, but we don't really know what the external factors
prediction market.
Yeah, so, and there's actually you can do a prediction on those. But at the end of the day, investments will always rise and will always fall over time. So it's never a guarantee to make money, but you have to understand the investment vehicle that you're investing into, and you need to be informed. And I always say you have to be informed to make an informed decision. You cannot make an informed decision with regards to any investment, whether that's property, whether that's finance. You cannot make a decision if you don't have the information to make a decision.
It's all about the education.
That's education.
And that is also why we started this channel. And then what is the most common mistake you see first-time investors make?
I think investors don't understand the investment vehicles they invest in. So it comes about misunderstanding the investment, and why I say that is you have to understand exactly in what you are investing, because if you don't have an idea, then how are you going to what can the outcome be if you don't know what you're investing at the end of the day?
So you would say it's easy to lose money in investments, especially when you're not educated or haven't done enough research on it.
Yeah, definitely so. And the other thing is, but again, it comes down to the first question of being informed enough to make that decision. But remember also, when it comes down to the investments, it's also about chasing performance. And sometimes you're chasing previous year's performance instead of current performance and future performance. So I'll give you an example, and obviously we can't mention any names, but there's a specific fund that I'm thinking about now that done a few years ago. The fund done 65% in the 1 year. Okay, obviously it's good and well if you draw up a fund fact sheet. So if you draw up the sheet where the funds details are on in terms of the performance and the benchmarks and the expense ratios, all of that. So this fund done a 65% return. The following year, he done 9% return. The following year, he done a minus 27% return for the year. So if you were chasing performance and you saw this fund after year one, geez, 65%, there's a lot of people that actually then chase it and then put money in this because, I mean, the fund done 65% last year, why can't he do it again? Then some of them that came late to the party invested, but they only got a portion of that 9% because that was the yearly performance. But if people thought, okay, you know what, I want to actually invest more than what I can afford in there, and they've done so, and they rode the cycle, they ended up with minus 27% in the following year. So it just shows you, and in that case, if a guy only came to the party beginning of the year when the market, when that specific fund deteriorated with 27%, you would have lost 27% of your capital. And remember, this is another thing that you have to understand, and we'll maybe elaborate a bit on this further. If your investment loses 10%, you have to get 11% to make up, to break even.
Yeah.
A simple example would also be, and maybe this will apply more to the audience, is that if you lose 50% of your investment, you don't only need to make 50% to get back to where you were at. to break even. You have to then make 100% of your investment.
Yeah.
So remember, if you invest and you lose 50%, you have to make 100% on that money again to make up the 50% that you lost. And people don't understand that, and that's very important, because if you do invest in cycles where the market goes down and down and down, and you're only investing as a once-off, just take note that if you're already investing in when the market, just before the market tanked, you have to get much more than that back in order to break even. If you understand what I'm saying.
100%. So Warren Buffett jumps to mind now. He says, be fearful when others are
Greedy.
bullish.
Greedy, and greedy when others are fearful.
100%.
And that's one of the things I think that people also don't understand, is where you have to invest in times, in tough times, basically.
But you have to be educated.
But you have to be educated about it. You can't just go chuck your money into something.
You kind of already answered my next question, where I wanted to ask about, what do you think is a dangerous investment? But I think you kind of touched on that point. And then also taking a risk with money that you cannot really take a risk with. So I think we often have the discussion where people want to invest. They want to invest in different investment vehicles, but they cannot even pay their credit cards.
Correct.
So what's your take on that?
So remember, investments is investments, and we spoke about this before in terms of credit card debt and overdraft facilities and all these things. That's high interest. It's high interest on these things, and if you're not investing
Short-term debt
is more expensive. Normally, in most cases, it's more expensive. But the thing is, if you look at short-term debt and all of these things, yes, you're going to have to forgo quite a lot of interest because you're paying that. So you have to be well educated enough to actually earn more than that. And in some cases, it's in a realistically speaking, over a 5-year period, the investment is not always going to perform 20% per annum for 5 years. There might be double digits, yes, it might be 10, 11, 12% in a normal traditional finance investment vehicles. But you're going to have to weigh up that and decide where you want to.
Pros and cons of each investment. Yeah. Then I'm just looking at the disadvantages and the fee structures of a lot of investments. And I know that often you will tell me that the client doesn't want to pay or doesn't want to do the investment because of the exorbitant fees or whatever the case might be. And I know that's a big thing in the investment market. The fees, because it is quite costly to manage money, manage funds, and obviously everyone needs to make a salary. I mean, you need to earn a salary if you manage other people's funds. So, but the funny thing is always no one asks what is the interest on my credit card or my short-term debt.
Yeah.
Then it's all good and well, and that's much more exorbitant than your fees to manage their funds.
So on
to
fees,
grow their money.
Correct. On fees, that becomes an entire discussion on its own. But just to quickly touch on that, so if we look, and the question you ask is valid, because looking at, if I sit down with the client and we look at investment performance and all these things, or even before we look at investment performance, and we would advise and recommend certain things to clients in terms of the funds, they will always ask, but what is the return? Because remember, that's the bottom line at the end of the day. It's always about what are you paying, what are you contributing, what are you putting into this investment, and what am I getting out. The nitty-gritties and things in between, they don't really care about it. If they make money, they're going to be happy. And as I said before, losses hurts more than gains feel good. And at the end of the day, if I ask that same question, if the client asks me, but what is the interest that I'm going to get? Because I want 10%, I want 12%, I want 15%, whatever the case might be. And I just put that question back to them and said, listen, but what interest are you currently paying? Not getting, what are you paying on your credit card? And they don't know. Then it's, Rainer, I'm going to have to, let me think about that. I have to, I don't actually know. And if I say 20 or 22%, their eyes like go and say, geez, I didn't know that much. And same with overdraft. So with all these things, so they don't always know. Again, it comes down to the education part. And that's why we're doing this, and that's why we are sharing our experience and knowledge on this platform, because that's stuff that one needs to look at. What is your interest rate on your bond? What is your interest rate on your vehicle? What is your interest rate on your overdraft facility? What is your interest rate on your credit card, personal loan? All of these things, because that, I mean, we live in South Africa. It's a very indebted country, and people love debt because they love to spend. South Africans love to spend money. And normally that is on credit. So yeah.
The book that jumps to mind is Psychology of Money, and I think people, there's different things people like to spend money on, and to your point exactly, they don't know what interest or that they are paying on debt, but they have problems with fees that they're
Correct.
paying in order to grow their funds. And I think it's all about the education.
And again, it comes down to education nowadays with all these AI models out there, and it becomes more relevant nowadays, fees, because I think also the general public are more aware of what is going on. Because at the end of the day, they can take their investment funds, or they can take the proposal given to them and they can upload it, and then they can on one of these models they can upload it, and then they can actually see what the fees are, etc. But just taking it a step back, if we look at fees per se investment, I think this is very important, because all investments, if it's a paper assets, got this. Okay, so when you're investing into an investment vehicle, whether that is a retirement annuity, whether that's a unit trust fund, whether that's a tax-free savings account, whether that's a local investment, whether that's an offshore investment, whether that's an endowment investment, all of these investments, structured investments, all of these investments carries some type of fee, some type of charge, because remember,
someone needs to manage the fund.
correct, and remember, it's a professional service that's offered, so you cannot expect to invest your money but at a £0 cost. It doesn't, because remember, there's professionals on the other side that's managing that money.
A doctor can't operate for free.
No, 100%. But again, for the clients on the other side to understand that that's a different ballgame. But when you look at fees per se, so back in the day, years ago, you usually got a thing called RIY, so reduction in yield. So when you look at your investment, let's say you look at the proposal, or you just looked at your investment quote that was given, you would have seen RIY, so it's a reduction in yield. It means it takes cost into consideration of the investment and how much does this investment actually cost you. However, the ROI did not include all the costs. So a few years back, EAC was introduced, which is effective annual cost. And the EAC of an investment, that gives you all the relevant cost, not only the total investment cost of the fund, because remember, you're investing in a fund. So I don't want to mention any names, but let's say you invest in an asset manager, let's say the big red company or the green company, and you're investing into those specific into a fund that an asset manager, they're going to be a fee that they charge, and the guy in the middle, the intermediary or advising on it, also has to take his fee, because he's the one that's basically facilitating the whole process as well. So with the EAC, so I don't want to elaborate on ROI because that's done, it's not relevant anymore, but on the EAC side of things, there's an administration cost. There's administration in terms of on which platform are you putting this money to be invested. Okay, because you can invest in one company, but through that one company, the funds can be invested in other companies as well. Okay, so then you'll have your administration cost using the platform. You'll be paying a management fee on that for the fund that's being managed. The money is going to a fund that needs to be managed by the portfolio managers of that specific asset manager. And then you'll have also an advice fee if there's intermediary involved. That's where we come in to advise accordingly, and we obviously have to charge a fee on that investment. So that's basically the cost. But remember, cost can erode some of the returns if it's quite
exorbitant. And I think without mentioning names, I think the advertisement or the advertisements that we get out there, that you see, that these big companies spend a lot of money on, they don't always, they give you the return, the total return, but they don't break down the cost. So you don't actually know what the real return is.
Correct.
They give you the return, but it's not the real return.
Yeah, you have to look at the real rate of return over time. But not only that, you're just going to have to look at what is the return stated and what is the net return, because the return stated in some cases is the gross return, not the net return. So you're going to have to look at that too as well, because that's physically what you're getting in your pocket at the end of the day.
Correct.
But as I said, it's not only the fees as well, it's also the tax that comes involved. And on this channel, we're going to talk a lot about taxes and things, and we'll eventually get some specialists on here as well.
So I want to talk about risk, but before we go to that, I just want to quickly ask, because we kind of touched on this topic now, on social media hype and the investment. So you kind of touched on this previously with regards to talking about a bribe, around the bribe fire, about what investments perform, and getting advice from your Oma and your Tani and whoever else. So what is your take on investing, on I don't know, on
hype.
think on hype, yeah, on social media hype, on.
So investments a lot about. So when we look at investments, it's a lot about the behavioral characteristic around that. So what I mean with that is there's a thing called behavioral finance as well, and it's basically how you make decisions, how do you make your purchases revolving around your emotional state, basically, okay, and your behavior and your experience with money at the end of the day. So what we'll do is, when you look at all these hyped up stocks, if I can call it as such, and there's many of them still coming to the market. And you mentioned your Oma. I watched a webinar the other day where the guy said, for instance, if your Oma tells you about the stock, then it's probably too late to invest in it, because remember that creates hype. So it's almost like you've got FOMO, it's a fear of missing out to invest in an investment that might perform, that might be the next get quick rich scheme.
Yeah.
So it's basically just about trying to avoid the hype, focus on what you need to focus on in terms of investing, following a longer term strategy, because a lot of the time the hyped up stocks, there's a period where it will increase quite dramatically, and then suddenly it will just collapse. And by the time that collapse, then it's already too late actually to invest in it. So I almost want to say, by the time that you hear of something that's out there already, it's almost too late to invest in it. Correct. But remember this, now I'm referring to a specific stock that you're investing in. And there is a few, like I'm going to name the company, a recent example will be SpaceX. No doubt that company will perform great over time, but in the short term, there's going to be a lot of volatility. And in terms of, when I say volatility, that's a volatility. It goes up, down, but
as long as it goes up.
Correct.
It's about the timing the market, eh?
Yeah, there's that saying that goes, it's not about, there's a saying about, it's not about the timing of the market, it's not about timing the market, it's the time in the market. Yeah. The only thing is that does apply. A lot of the people will agree with it, a lot of the people will disagree with it. There is some form of truth in that. It's about the time in the market, because at the end of the day, and we can speak about compounding growth and all of that in a second, because that's about at the end of the day, it's compounding your growth over time, and that only happens over time. Compounding can't happen in a month or two time, it happens over time. But the timing of the market, that's where it is applicable in some cases. Like I would say, people trading the market quite often, for them it's obviously that's very important, the timing in the market. But at the end of the day, for long-term investors, it is the time in the market.
Retail investor.
Retail investor.
The money in, forgetting about it. Correct. I want to say. Yeah. So that brings me to my next point of the risk, and also about diversifying. So one fund that comes to mind is S&P 500.
Yeah.
If you can elaborate on S&P 500 versus exactly what it is for the normal retail out there, or normal I want to say individual out there. What is the S&P 500? Is it recommended? And then also, what is the risk involved?
Yeah, so for instance, you get S&P 500, you get the JSE Top 40. All these is index funds at the end of the day. So you're investing in an index that tracks these companies. Where the S&P 500, it tracks the top.
So explain index fund to someone that maybe doesn't know.
So an index fund is basically where basically what it says, you're tracking the index of a certain amount of companies. So let's say there's 500 companies on the S&P 500. If you invest in this fund, it tracks all 500 companies. If a company becomes 501 and the one that was 501 comes into 500, then you'll be investing in that company. Okay, there's obviously certain specific and requirements, and it's quite regulated.
So these are 500 top performing companies.
Basically. And in South Africa, you've got the ALSI Top 40 or the JSE the Top 40, and that's our top 40 companies. So that's normally names that
low
you see.
Risk.
No, it's not low risk at all. It's all that. Any index fund is actually an aggressive investment, because remember, you're investing in equities, you're investing physically in the companies. Whether that companies perform or not, it's all dependent on the market conditions. We'll discuss the most important risk is probably inflation. We'll get to that now. But on the indices, for instance, if you're investing in a top 500 company, or let's say you're investing in the S&P 500. Currently, it's very, very concentrated. What I mean with concentrated, even though if you're investing in a top 500, or let's say an index, in an S&P 500, which is the index fund, even though you invest in that company, you think, geez, I've got exposed to all 500 companies. You do, but remember, the Alphabets, the Amazons, the Teslas, the Nvidias, the Apples, Microsofts, all of those companies are right on top. And that's a massive concentration part of the top 500. So there was a stat the other day, we'll just have to check it again. I think it was at 32% which means that there's, I think the top 7 companies has 32% of the entire index. So it's very concentrated, because a company like Nvidia sitting at about a $5.5 trillion market cap in terms of valuation. It's a massive company. So in the index, very simple example, if the index is, let's say, worth 10 trillion and a company's got a 5 trillion market cap, it's 50%. So you think you're investing in this index, but you're investing in most of it. So if something goes wrong with this company, again, if something goes wrong with any of the AI companies, because most of them is on the top, if something happens in these AI companies, it can have an effect and skew performance on your side. Even though you think you are diversified, don't get me wrong, but it's a very concentrated
So would
market.
you say it's on a risk factor, would you say the S&P 500 is worth investing in, seeing that it is still diverse?
Yeah. Look, obviously I can't give any advice on this channel, and again, it's for education purposes, but I do think that the index fund, it's good if you have it in your portfolio, because that also reduces the cost. Remember, if you're investing into what is called a tracker fund, it tracks the index and all of that. The cost is definitely, most of the time it's less. So sometimes if you incorporate that with your other portfolios, because that's what we do as advisors, we go look at the client, setting up a proper portfolio for the client, having this top 40 funds in there, having the S&P 500, having some of these funds in there to also reduce the cost in terms of investment, but also investing in certain funds that don't invest in all of these companies in the index. Because remember, and that's what you see a lot of the time, you'll see that there's currently at the moment, there's a bit of a steering away from the AI sector. Yes, there's still a lot of investment happening in that, but steering away into companies that maybe focuses on defense, for instance, and not specifically an AI-driven company. So that's a diversification method. But you have to diversify your investments. So not only investing in all these companies.
So I want us to elaborate a bit more on the risk, but this last segment actually brings me to my next point, is having too many investments and too large of a diversification, if I can put it that way.
You can be over diversified.
So and I think that it definitely it differs from person to person and portfolio from portfolio to portfolio. So what would you say someone that's in their 20s, for example, that wants to start something, because like we've mentioned previously, and I think one of the big things is age is definitely a benefit that no one can argue against. But obviously you don't always have the money in your early 20s, for example. So what would you say? 20-year-old wanting to invest, just started out with the 20 or 30,000 rand salary. What is your recommendation?
So I think firstly you have to take a step back. So good question, but you have to take a step back in terms of, firstly we determine what is your goal, like what are you investing for, because when you're 20, 30, 40, 50, your goals is going to be different. Okay.
And the risk is also
different, because you cannot take as much risk in your 70s as what you can take in your 20s, for instance. And what ends up happening a lot is people taking risk late in their life, and then they actually get into such things.
So someone 50 years old, retiring at 60 or 65, coming to you with 250,000 investment and say, I want to retire in 10 years.
No, that's not going to happen.
I want 3 million out.
No, that's not going to happen. So but we do get that question often. Actually, it sounds actually funny now, but we actually do get those questions on a daily.
People wake up too late.
Yeah, it's people leave it until late, and it comes back to compounding effect. Again, no magic formula. It's literally the compounding effect of your investment. So just to quickly go back to your question on the 20-year-old. So first you have to determine what is your goal for the investment. Then you determine what is the investment time horizon for the investment. So obviously the investment time horizon is, again, it's going to be different for a guy 20,
so
30,
you
40,
mean about
50.
the period in the market?
Yeah, what is how much time does he have to invest his funds? So that's the investment time horizon. And the third important thing is to diversify. So that touch on all your things that you've mentioned now, because on the diversification side of things, you have to be diversified into different sectors of the market. You cannot only putting your money all into one stock because you believe that this one stock will do good. Sometimes you hit it, sometimes it can go exceptionally well, sometimes it cannot. But you are not limiting your downside risk. There's a lot of downside risk in terms of investing into a stock that can fall 30, 40, 50%. Yeah, so just to quickly go back, for a 20-year-old, for instance, it's going to be different for 20 years, 30, 40, 50-year-old, because the 20 year, as I said, he's got a different goal in mind. He wants to obviously accumulate as much funds as possible over time. So that's his goal. But on the 60-year goal, want to maybe accumulate funds now for retirement purposes, for instance, or he needs to then invest for retirement purposes or at retirement. So he needs to maybe invest in less risky things because the market can be very volatile. So if he takes quite a big risk, and there's a downfall in the market, like a COVID happened, that can affect your long-term income withdrawal from it. So that's on the goal, and on the investment time horizon, just touch on that first point, and on the diversification, as I said, you have to be diversified.
So diversification is all good and well, but if you're 20 years old and you only have limited funds to invest, because at the end of the day, if you a lot of people, I think, say they don't have extra money at the end of the month. They have more month left
at the end of their money. They've got more month left at the end of the money. That's for most South Africans, by the way. That's
and then credit cards and student debt and all of those things come into play. So if you have limited money, you cannot diversify. I mean, it's also, I think it's a big thing where someone comes to you and say, I want to diversify and I want to invest, but I only have 2,000 rand in the month, so or left, if even that much. So I think it's important to start somewhere. You have to start.
Yeah,
that's start somewhere and then build it from there, I think.
Yeah. Remember, we're also looking at the self-employed individual and the guy that's entrepreneurial spirit. He's got 3, 4, 5 companies going, etc. He's investing most of his cash most probably in that business. So what happens so if you've got 5, 6 different businesses, obviously you've got diversification, okay? If you've got one business that you're chucking all your money into and that business don't work out, it's a bit of a problem. And if you've done that for 10, 15, 20 years and the business goes through a bad time and you close up shop, for 20 years you've just been investing in this one business and you did not invest in any other. So I would always say invest in the market as soon as you can, because that is definitely going to help you over time. You're not going to be shooting the lights out every year. There's going to be times when the market dips. You are going to get to years where there might only be 4% or 5% return or whatever. There might not even be a return. But the longevity of it over time, the average, if you invest in good assets, should be double digits over time on an average basis. So there's that rule of 72, which basically said every 7.2 years your money should double. It can be, there is some funds out there, structured investment, where it actually happens like 5 years. But yeah, the rule of 72, go check it out. That's also something, it's like a general rule.
So this is also now purely based on traditional finance. Yeah. So now the interesting thing comes where you get your non-trade
alternative investment,
your
private equity, private debt, hedge funds.
Not even talking about cryptocurrencies.
Not even talking about
that's where people get excited. It's more exciting than your traditional finance. It's almost a.
It's not boring as the.
It's not, and it's quick. It's fast. It's exciting and
that,
people think they're gonna get rich quick.
That comes down to the hype sector, because you remember years ago, and it's still nowadays as well. And I've done a lot of research on this as well. If you look at the whole from 2009, it didn't really take shape here by us until like 2011, 2012, cryptocurrency. Okay, so there's many, but Bitcoin being the most prominent one, obviously. So a lot of the social hype was around cryptocurrencies, and it has faded a bit, but there is still a lot of speculators out there, and I can almost say, how can I put this? Not really investors, but speculators, speculating that something might go up. I'm not saying it's bad. I'm not saying it's good. It's about what your risk tolerance at the end of the day. Because if you've got a high risk tolerance, you can definitely invest in these speculative assets. But as long as it's not all of your money, maybe 1 or 2% of your funds put in this. But there was a lot of social hype created around cryptocurrency. And every second guy on TikTok or Instagram or whatever, all these influencers spoke about cryptocurrencies. And what happened? Where are those guys now at the end of the day? When obviously there's a rally again, you'll definitely hear from these guys again. But that's about social. So just educate yourself enough to know in what you are investing. And that is why a lot of the guys, specifically in cryptocurrency, don't invest in it, because they don't understand it. For those that understand it and see value in it, those are the guys investing in it. And for the speculators out there, there's a lot more speculators actually just investing and chucking the money and hoping for the returns. And remember, hope is not a strategy. Hope is never a strategy.
It's
even though sometimes
almost like gambling to a certain.
Yeah, look, at the end of the day, it's if you don't know in what you're investing, it becomes an issue. But again, I'm not taking anything away. cryptocurrency, I think there's a place.
Do you
but
think
not
it
only
should be
that.
part of your portfolio?
I think so, yes.
Yeah.
Unfortunately, it's not regulated to such an extent where our local asset managers have it included. Yeah, and there is a few, but the regulation is quite tight on cryptocurrency. In South Africa, in the US, etc., a different story. But I do think you have to have a bit of your portfolio in speculative assets, because sometimes that speculative asset can perform well. But again, it comes down to creating a portfolio, structuring it in the way that will suit you, because what will suit you won't suit. I can't invest 8 years old grandma's money into a cryptocurrency product. You understand? Yeah. It's too much risk to take at that stage. But the younger you are, the more risk you can take.
I actually remember a story about when Bitcoin was on a bull run a couple of years ago, when it was just starting out in SA, coming the next big thing, where I was standing in the bank where a guy actually said he's gonna almost sell his house to a certain degree, it sounded like, and put all his money into Bitcoin. I mean, that is just ludicrous.
Yeah.
And that's because of the hype.
Well, if you done that and catch it out at the right time, then you would have made a lot of money. But again, when it's the right time.
Yeah.
So, but also another thing, remember diversification. There's a saying that goes around: diversification is only free lunch, which means, remember, you can diversify.
Inspiration isn't.
Yeah, no, definitely not. So that is, you have to diversify. It comes down to what assets are you investing in. You're not putting all your money into one basket of things. You're spreading it around, and you can spread it around by just having different types of structures and investment vehicles in place, which we obviously can assist with.
Yeah. What would you say? So now someone is getting a little bit older, family is growing, obviously, because that will also change the structure of your investment. So family is growing, then funds can maybe become a little bit tight. And I don't know how often you see this. I mean, you deal with this, I suppose, on a daily basis, where someone now has invested for a couple of years, but now they need funds. They need funds for school fees, and they need a bigger house, and transfer costs, and all of those things, bringing it a little bit back to property. But what would you? I mean, what's interesting stories that you can share with regards to that?
Again, comes down to the goal. When you started investing, how much are you investing into your fixed period? So, take a step back. If you go to the bank, or again, not mentioning names, but they will offer you savings products basically. So remember that's, and I think we can have a totally different discussion on that at some stages. What is the difference between savings and investments? Because there is a difference between the two. A big
both
difference.
Necessary?
I would say yes. Savings in terms of emergency funds and things like that. Always make sure you've got a bit of capital for emergency fund before you're actually just taking all your money and investing into the market. So there's savings and there's investments. There's a big difference between the two. Again, clients out there don't understand, or consumers don't understand the difference between savings and investments. They think if they have the money in a money market fund, or in a notice deposit, or in a fixed deposit, or in a 32-day notice, and all these other, there's many of them, all money builders and all these names for this stuff. At the end of the day, that's not really an investment. That's a savings. That's a savings pocket. Okay, I'll always say that's almost like a parking space for your money until an investment comes along that you can actually invest in. But it's not an investment vehicle per se. And you will be surprised.
You get interest, but it's
you get your interest, and it is conservative in a sense, but that's not. It doesn't help you sit with, you sell your house and you sit with all that money in a money market account. You'll get interest, you'll be taxed on the interest as well, but it won't really. It's
linked to CPI?
Inflation related, yeah. So they will normally give you above inflation related, but remember, inflation, if it's low, interest rates is low, you're not getting that much. I mean, interest rates is high, it's good for savers, but bad for our.
And some of these funds, I think you should be very wary of not losing money.
Yeah, there is obviously some.
I think these days
yeah, but we're gonna come to the purchasing power. I think we will touch on the inflation side of it now, because that is the biggest risk with any investment or savings for that matter. But just quickly going down to the question of where would you invest your money starting out the family now. If your goal initially was to invest for the long term, and now you've placed your investment into a 5-year restriction period where you will be penalized taking the money out in the first 5 years, and that obviously becomes the issue. If that is triggered and you need money immediately for maybe you're 2 years in, you're starting a family, you need the funds, you need to pay this or pay that. Life happens and you withdraw from it, there will be penalty charges. In some cases you'll be worse off than you were when you started.
But also with the fixed funds, if I'm not mistaken, more often than not they are prone to grow a little bit better than your...
Not necessarily the structured investment things with predetermined guarantees is built into all of that. But when I say guarantees, it's not really a guarantee, but it's predetermined values given. Because remember, it's the guarantee that was coming down to the first question of can investment guarantee to make you money? Guarantee is a word that not of investment houses will actually use, because a guarantee, it's never going to be a guarantee. Okay, even though people talk about it and in the terminology they will use guarantees, but there's never really a guarantee, because remember, and this might be technical, I'm not going to go into this, but the banks carry certain credit risk. So if they default on the credit and things like that, if your investment is I can almost say underwritten by them, it becomes a bit of an issue. If they default on the debt, if they default of the debt, no, it's not something they have control over. It really happens, but in the US, if you look at over 4,000 banking institutions, it happened with a lot of their banks has gone through some.
100%. I mean, there's a lot of horror stories.
Yeah, look, in South Africa, I think from a banking regulation perspective, our banks is very well managed. But yeah, before I go off course here, so at the end of the day, if I look at the guy starting out the family, again, it depends on his circumstances. But in most cases, I will always say, and that's why it comes down to diversification again, not only diversifying in which you invest, but diversifying into which product you're investing. Because you get things like unit trust where the fund is accessible at any time. So you can put money in there, you can take it out at any stage. Just take note that when you are investing in these things, you still have to have a strategy, because you can now invest into, let's say, unit trust. You can invest into this unit trust and you can invest into a very aggressive investment. There will be volatility over time. But what happens if there's so much volatility? Let's use that fund that I've used now previously, saying that 27% drawdown in the 1 year. So now you invest into this fund that done so well in the past. Now suddenly the fund loses 27% of the value. Let's say you've invested $1 million. Okay. Well, good luck to the 20-year-old that's got $1 million. But let's use it for example purposes. You've got $1 million. Now suddenly after a year you've got 270,000 rand less. Remember, as I said, if the fund goes down 27%, you're going to have more than 27% in upside to break even. So now
you've lost that time.
And you lost the time. But now what happens if you've only had a year for the investment? Now suddenly you're sitting with 730,000 from your million, because you've lost 270. Okay. Now you're sitting with 730,000. Now you need that money immediately. You have to cash it out because you have to pay this and that and that. Obviously, the money is still accessible because it was put into this unit trust vehicle, but the strategy was wrong completely, because you've taken so much risk and you ended up needing that money within the first year. Yeah. Okay, you can also go the other way. So, but again, diversify in the investments and also diversify in the product that you invest.
So that brings me down again to the risk factor. So. And this is about finance and property and investment. So what would you say from your point of view with regards to a risk factor on paper assets, investing in paper assets versus property, for example?
I would say one answer, inflation. It comes down to inflation. Remember, inflation erodes the purchasing power of our money on a yearly basis, actually every day in such a sense. But it erodes the purchasing power of our money. So every year, your 100 rand becomes less and less and less. And you would think now, and for the viewers as well.
So to save cash in your couch is maybe not that.
No, man, only for our president maybe. That works out for you. But anyway, so if we, your 100 rand now, if you look at 10 years ago, let's say 20 years ago, you went shopping with your parents, 100 rand could have bought you a whole bag of groceries. Obviously, things were cheaper back then, but it's also not cheaper because it's relative to current times. So yes, living cost has increased quite dramatically, but inflation, that's the most risky factor of any investment, whether it's paper assets, whether it's brick and mortar, whether it's any other investment. Inflation, again, as I said, it erodes the purchasing power of money. The money gets less over time. So if you don't invest it in either a paper asset or in a property or whatever the case that can yield returns above inflation, you're going to be sitting in shit street over time as well, because your money's not going to grow fast enough. And it's not going to keep track with inflation. Yeah. Inflation is growing much faster, and when that happens, then things become skewed. And remember, if you did not, simple example, if you did not invest, let's say you don't have any investments, no investments at all, no paper assets, no property investments, nothing. So what happens is, if you took the 100 rand and you put that under your mattress for 5 years, and you do not invest that 100 rand, and you take that 100 rand
Out 5 years later.
out of your mattress or under your mattress, whatever, you take it out 5 years later, then your 100 rand would probably be worth maybe 60 rand. We can do the calculations, maybe 60 rand.
The purchasing power will be less.
Correct.
Yeah.
So then you take the 100 and you go to the shops. Your 100 rand is actually now worth a 50 rand and a 10 rand note, basically. So you are going to be buying less. So, but if you took the 100 rand and you invested it into a vehicle, which could have given you, let's say 150
years,
correct,
should have doubled.
So let's say then you would have kept track with your purchasing power of the money,
yeah.
and that's the number one risk when it comes. If
And
you can beat
always
inflation,
outperform.
if you can outperform inflation, then you're good to go. But also take note, there's a thing called CPI, Consumer Price Index, and this is also something that one needs to think at, because when you look at CPI, it's actually a bit of a skewed figure because the CPI is only consisting of a basket of goods, right? And that CPI, it's 4%, 4.5%, 5%, 6%. I like to use an average of about 5 and 5.5% or so on average over time. But years ago it was higher, and there was also times when it was lower. And we can.
So just to put it into perspective for the viewers out there, if your property you bought for X amount, and that area where you bought is only growing at, let's say, I don't know, 2% or 3%, and CPI is at, let's say, 5%, then you are losing money essentially.
Basically, yes.
Yeah.
Because you poorer. You become poorer every year if you're not tracking. But as I said, on the CPI front, so CPI is much lower than the actual cost of inflation. If you actually go work out your own inflation, and each one's inflation is less because each consumer have a different basket of goods, basically. If you like steaks and let's say you like to buy red meat from time to time, and you like to buy nice things for yourself and all of that, the inflation or luxury products, it's much more than what the basket of goods is in South Africa. So you think, okay, if I can do 4 or 5% per year, that's okay, because I'm going to be tracking with. It's not okay, it's tracking with inflation, but I mean, then you're okay. But on the other side of things,
it's also based on essentials.
It's based on essentials, and not all people. So obviously everyone needs essentials, but some people buy outside of the essential basket, and you will be surprised, easily between 15 and 20%. So just wrapping up on the inflation front is, always make sure to see what inflation is, because remember, inflation has an effect on interest rates, and interest rates has an effect on all the other things that we also discussed. So it's almost like if something happens on the one end, it has an effect right through till the end. Doesn't matter what investments you do. So again, always make sure you outperform inflation, because that's almost like a benchmark. You will always see, if you look on the fund fact sheets, or fund fact sheets meaning the investment where you're investing in, the fund we're investing in. It will have like the benchmark will be a CPI plus 5%, or a CPI plus 3%, or a CPI plus 2%, because that's a good measure in terms of a benchmark that they use to see
to show you that your money actually
correct. And that's why I say inflation is a benchmark used, but again, it can alter your investments quite a bit if your investments does not outperform, and that comes back to the savings and investments, but we'll elaborate on that at a later stage.
Question. I see there's a lot of scams out there these days that makes a lot of money, so where can I invest?
Yeah, that's
a lot of unregulated investments.
Yeah. So
everyone's got the next big thing.
So yes, I can keep you guys busy all day with regards to this, but yes, there's a lot of scams out there. Like we in the industry, we struggle to keep ahead of it and to try and stay updated with it. I've personally had some clients that went against my advice and said, okay, I say a lot, there was probably 2 instances that I can think now that client went against my advice to invest into something, and then they actually invested and it was a scam, and they are still waiting for the money up to today. And I'm referring here to clients that invested in 2-3 years ago. Anyway, so with regards to scams and unregulated investments, obviously when it seems too good to be true, it probably is. You get that old saying. And that is very relevant when it comes to these things. And with AI specifically, there is a lot of scams going on. So always check the facts and figures first. Make sure that the advice comes from, if you're receiving advice, that it's a regulated. It's a regulated
and a reputable company.
A reputable company. The advice is regulated. That there is a FSP license from where you're getting this advice from. There's a lot of things that you have to check for. But obviously, it's easy for me to go check. Okay, is everything there? But for the average guy out there, you don't know if it's regulated or not. They don't know what to look at, so it becomes difficult. And obviously, the fraudsters, they know this, so they are quite on top of it.
And AI isn't making it easier.
And AI is definitely not making it easier, but there's just been a few recently that just just ridiculous. So if you invest 4,500, you can get 500,000 rand a month, stuff like that. When it just doesn't make sense. But still, there's a lot of people and some educated people as well that fall for these things. So people chase these investments where they get these massive double-digit returns. If you're getting 30, 40, 50% in an investment, geez, take note that if other companies can't provide you with that investments or that similar returns, what is this company doing or this person doing that can give you this?
Where are they investing?
And where are they investing? Because there's a massive institutions out there that spends not millions but billions with a B in research and development, and that spend a lot of money in research to research stocks and research companies and so if they can't give you the returns, how can this guy that's running the business out of his garage give you this this advice? Yeah, no offense to people running businesses out of their garage, but I just mean from if it doesn't make sense. So yeah, always be aware of scams because there is many of them.
And then with regards to investing offshore, obviously, is there more risk involved in that? Is it similar? Is it advisable hedging the different currencies against one another?
Yeah.
You're arbitraging.
Yeah, arbitraging currencies. Okay, so arbitrage, that's a different type of investment, but the long and short, to put it into context, basically South Africa is about 0.28% of the entire world from investable assets. 0.28%. That was the last stat. So let's run up about 0.3%, more or less. Okay.
So you are saying we're small.
Africa as a whole is a 1%, slightly bigger now. Okay. So in context, that's a very, very small percentage of the world's investable assets. So if you're only investing in South Africa and only investing in South African companies,
only exposed to
the rand. Correct. You look. Also, I must say, a lot of our top companies are getting earnings offshore. Like you get a lot of these companies, like Richemont, for instance, and AB InBev and all these companies. A lot of them are getting the earnings and things offshore because it's actually international companies, but are listed in South Africa. Some of these companies are listed in Europe and in South Africa, for instance. But that's technical. We can go into that. But the thing is, if we look at the exposure only in South Africa, you are very, very limited. So it makes sense to invest offshore because not only because it's cool to invest offshore but it's also about you. There's much more opportunity in terms of the companies.
Is there minimum amounts that you can? Or?
There is certain minimum amounts because it doesn't help you invest $100 offshore, but you have to pay $25 fees, for instance. Okay. So you understand? So it comes down to the fees.
Can absorb your.
That's why that is why a lot of these different investment products and vehicles has certain minimums when you invest offshore, like $15,000, for instance. Because remember, it needs to be worthwhile for the company you're investing through as well to invest that money for you, and obviously there's a fee involved. So, and remember, it's expensive to take money. Usually it was more expensive, it's not as expensive anymore, but to invest offshore there is some fees and things applicable. And very important, take note, there's the 2 million offshore allowance that you get, that everyone gets.
It's called the $1 million, eh?
Used to be $1 million. They've upped it now. After many years they've upped it to 2 million. It just means that you can take 2 million offshore without having to let SARS know. That's the long and short of it. You've got a single discretionary allowance, and then after 2 million then you can have another additional 10 million. So in effect, you can invest 12 million offshore. But if you first depleted the first 2 million in the year, and then you can invest the additional 10 million, but you have to have SARS clearance for the issue with the approval, basically, etc. So, but the long and short of it, yes, you have to invest offshore because our market is actually very small. So if you're only investing in South Africa, you are basically going through investments like this whole world out there at the end of the day. But again, as I said,
you don't know what you don't know.
You don't know what you don't know, but it also becomes it can become expensive if you're investing small little amounts because it's not that feasible then. But the big thing is rand currency hedging. I mean, that's a big thing because if you're taking the money offshore while the rand is strong. So in this case, currently, while we are shooting this, the rand is quite strong relative to the dollar, for instance. So if you're investing in the US markets and you're investing directly offshore, you are getting more bang for your buck because the rand is stronger, so you're getting more for your rand. At the moment the rand weakens, if the rand goes from 16 rand 50 to 17 rand 50, for instance, that's a 1 rand weaker, so you're buying less buying less.
dollar of
Correct,
euros
because the
or
rand is
whatever.
weaker.
Yeah.
Okay, so while the rand is stronger, you want to invest offshore. When the rand is weaker, you want to obviously take some
So
funds
that's
back
where the hedging comes in, and just
to externalize funds.
going back a little bit with regards to different type of funds, so index funds, things like that. So, I mean that's more your traditional, more a little bit more boring. I almost want to say.
Yeah, you can still invest in your S&P 500 and things because it's an index fund. So you're not investing dollar denominated, because remember you get direct offshore investments and you get almost indirect offshore investment, to understand it too. So you can physically, when I say investing offshore, you can directly invest offshore, meaning you're taking your rand, converting it to dollar currency and investing it offshore. So you're physically converting that fund, so the money is literally domiciled in dollars offshore in an offshore account.
I think that kind of investment is a little bit more exciting.
It is, because there's a lot more factors involved. But so that's the direct, and then you also get indirect, which is called in our case feeder funds. So you can go check up on that feeder funds. It's basically just you're investing in rands, but it's still an offshore investment, but it's via a rand denominated, not dollar denominated or euro denominated or pound denominated. But I mean, that's where you need to get the advice in the event of investing offshore, because you need to know there's a lot of technicalities involved. Obviously, to elaborate on that, it's going to take quite some time. But yeah, so that's basically the long and short of it.
Okay, then with regards to the different types of investment, paper assets versus property. For me personally, I feel that property is just something that you've got more control over, where with paper assets, what control does the investor have?
Control. Well, the investor has...
Because obviously you investing in someone else's company essentially.
Correct.
And
if you're investing in equities, correct, yeah.
And if that company, goes down for whatever reason, then, what's the risk factor there? I mean, there's nothing that you can do about that.
No.
Once, if you're in, you're in.
Yeah. So remember, both carries risk. It's just a different risk that each one carry. If we take it back to the property segment of it, you've got completely different risk. You've got risk with tenants, you've got risk with maintenance, you've got risk with additional expenses popping up there with regards to the maintenance of the. So there's that risk. So it's a complete different risk to investing in a unit trust where the fund doesn't perform due to maybe they're going through a tough time in the market, or maybe they develop products or something which there's a ban on. So there can be so much things, but it's complete different risk. Because remember, if you're investing in an investment fund, you are almost like you're giving the money to someone else to manage. So if they manage it well, you obviously receive the reward. In terms of the property, you can also obviously subcontract that risk, or I can also say like put that risk onto someone else. But at the end of the day, if you're sitting with tenants and things like that, that's a complete different risk than with them. So each carries a risk. There's no thing as a no risk investment.
At the end of the day, it's still even if you're investing in property, it's still a business that you're investing in essentially. And taking it a step further, if you're investing in a REITs fund, which will be more a paper asset, just investing in a large property fund, a real estate investment trust fund, then you also essentially don't have you've got less risk, because you don't deal with it. You have less direct risk, so you don't deal with the tenants and the maintenance, all those things, but you're still investing in a company that's managing property. So
yeah, so if you look at if you look at the REITs are essentially the real estate investment trust basically. So we say REITs, REIT. So the long and short of it, that's companies. For instance, let's say you don't invest in physical property to buy brick and mortar, and now you're renting it out. You can invest in a fund that still invests in property, but it will be in companies like your Growth Point properties, or your Vukile properties, or your Redefined properties. And there's a lot of these listed property companies, so meaning you'll invest in them. But remember, that also now carries a complete different risk again, because what happens when the interest rate goes up? Remember, these property companies has finance for that property. So if they've got bonds on it, basically essentially they've got bonds on it. So what happens is, if that risk, if the interest rates goes up, suddenly immediately their cost goes up. But what happens if the tenants only pay X amount, and the tenants also cannot afford that increase in the rent for the next year? Maybe they lose that tenant, then there's let's say for instance a shopping center sits without 10 tenants or 10 empty stores. and it happens in 10 empty stores, what happens then? Same what happened with COVID, exactly what happened with COVID. People can't pay their leases, the risk then falls upon the property companies. Remember, you are invested in this company, so essentially you're also carrying the risk. So even though it's not your tenant over here, you're investing through this company, they hitting lows in terms of the rental income, which is going to affect the payouts to you at the end of the day, in simple terms. Yeah.
So Rainer, diversification is obviously a big factor in the investment sphere. Offshore investments, traditional investments, etc., etc. What is your? I mean, then obviously there's people that say that, but traditional finance is boring and don't want to invest in it. That's why foreign investments or
sounds more exciting.
Offshore investments more exciting. What's your take on it?
Okay, so we've spoken a lot about diversification today, and diversification is definitely, as I said, it's the only free lunch you get in investments. But it's also, if I just tell people diversify, they say, but what do I diversify? And I don't even know where to start. Like, what do I diversify? Because we talk all these things, and it's here and it's there and it's all over, and there's a lot of stuff, and you don't have budget for all of these things. But just to, I think, to close on that question is, if you diversify, then you have to diversify into specific segments of the market. Okay. What I mean with that is, if you invest in funds, you can invest in different companies, okay? Different companies you can find on an index fund, for instance, okay? So you've asked me about the index funds and all of these things. So if you're investing in an index fund, you're investing in all that companies that sits in that index. So let's say it's a box with 500 companies, for example. You're investing into that box, and that money will jump around in the box in the companies where it is, and you'll get the relevant returns from there. Obviously, returns as well as losses. You partake in returns as well as losses. Obviously, you can't only partake in the returns, otherwise every would be So you partake in the upside, but you also partake in the downside. So there's a famous book that was launched a few years ago, and in that book, the author mentions as well, so he doesn't own a lot of properties and things like that. He follows a simple, straightforward approach. He's just investing in the S&P 500 fund, which is an index fund. It's a passive investment. And he just chucks all his money in there, and that's what he does. He thinks that it's best to just invest. So that's his take on it, just to invest into this S&P 500 index fund, and just let the money accumulate over time as he gets funds in investing in there. He doesn't really have to do he doesn't have a lot of effort, because he's just putting the money into the fund, and the fund is being managed, and that the companies that invest in is being managed by other people at the end of the day. And so
he's a passive investor.
He's a complete passive investor, and that's his take, and there's nothing wrong with that. In some cases, that's actually a very easy and straightforward and simplified way to do things, and he's happy with the returns. He still diversifies, not maybe in properties and in investments and all of these things, but he still invests into the passive investment with all this. So he's investing in different companies. He's very much diversified, even though he only invests into one specific portfolio, one fund. That one fund is investing in all these companies. So he's still diversified, but in a different way he's diversified. So that comes down to the point of diversifying, but where he's diversifying with this. So it's a famous book actually. That was written, and it's a simplified approach of investing, basically. So Albert, you've asked me a lot of questions today, and I've given you quite a bit of answers. What have you learned in this podcast today?
Look, the long and the short is, I think you need to educate yourself. You need to know what you're investing in. Don't invest in something you don't know anything about. Warren Buffett jumps to mind. He always says, you need to know what you're investing in. If you don't know, don't invest. That's my 2 cents.
So in the long and short of it, the lesson that we all learned, I think, today is that you have to understand the risk where you're investing into. Firstly, you have to understand the risk, and that no property or financial investment is bad. You just have to understand what you're investing in.
All comes down to education. Educate yourself first before you start.
And being informed to make
before you start parting with your money.
Correct. Yeah, so that's a wrap of today's podcast. I hope the viewers learned something. And we're doing a bit of a giveaway. So what we've done throughout this podcast, we've made reference to a book. So if you can comment below on YouTube, the author and the title of the book, we'll choose a lucky winner and we'll send you that book. But remember, you have to be a subscriber on YouTube. Thanks, guys.